Good evening. Welcome. My name is TK Kugler. I am the founder and managing partner of Wasabi Ventures Stallions. And honestly, I put this together over the weekend, this presentation. I've been thinking about it, and I really believe this is going to be one of my favorite webinars we've ever had at Stallions. I actually had a lot of fun putting it together, and I think it's really interesting education. And so we're going to talk about private equity key metrics, and we're going to do that from a lens of Wasabi Venture Stallions. But almost everything, and I'm going to highlight this a lot, almost every single topic that I talk about tonight is applicable to whatever type of alternative asset investing you might be doing in your life: real estate, venture capital, gold coins, whatever. This is going to be applicable, the lessons that I try to talk about tonight. So without further ado, let's jump in. It's important to understand that this is an investment discussion tonight. So from a perspective of, we are talking about an investment vehicle. So this is, but like all investment vehicles, anything that you might see about returns or hypothetical forward-looking statements, are not necessarily guarantees. And nothing that I talk about tonight is a solicitation for you to actually invest with Wasabi Venture Stallions. You have plenty of opportunities to do that in other forums. So it's a great place to start by talking about and understanding the basics. And even though I told you this is going to be a discussion where almost all of the topics are useful, and no matter what type of investing that you do, understanding the basics of Wasabi Venture Stallions is actually going to give you a frame of reference as you get the education tonight. So what is Wasabi Venture Stallions? It's a venture capital style alternative investment fund where all of the assets are thoroughbred breeding assets. And we'll talk about what those are. And all of the funds are annual 10-year funds. Those two data points are going to come into play here as we dig in. So it's good to have that frame of reference. So the first thing to understand about Wasabi Venture Stallions funds, but really, once again, to any type of private equity fund, any type of alternative asset fund, you're going to hear this term called a J curve. Okay. And so what that is kind of with the picture that you see on the screen. Every fund has what's known as a J curve when you're talking about, like, in the private equity world. And what does that look like? Is that the J is the investment period. That's when you've collected all the money, and now the investor's money, and now you're making those investments. Well, obviously, as you make investments, the curve goes down. That's the internal rate of return is dipping, right? So that's why it's in red. Nobody likes when it goes down. But what the key to the J curve in all funds is that you want that curve to be as shallow and short as possible. It's never going to be flat, because by definition of private equity, they're not liquid assets. You don't just buy and sell them on the street corner. So you're investing so that you can get returns later in the year. So you want the curve to be shallow and short in number of years. Remember, once again, we're talking about a 10-year fund. So if you look at this curve, and we're going to talk a lot about this, and we're going to look at results, we really try to think about the bottom of the J curve being in years 3 and maybe year 4 at the most, and then everything starts swinging up from there. And then you want the J to go straight up. I know I saw a couple of people who are teachers on here. When you teach somebody to write the J, you want it to go straight up, right? And that's kind of what you want out of your J curve as an investor as well. So when does the fund earn returns? Once again, it's a 10-year fund. So this is a really interesting chart. And what I want you to, and we're going to talk about that, the type of asset, those 4 assets on the left are the categories of all assets that we invest in. Everything we invest in, once again, are thoroughbred breeding assets. It has nothing to do with racing. It is attributed to it, or it has affiliation to it, because obviously horses that get bred eventually go off and race. But really, the investment vehicle is around the breeding aspect of it. And for a different webinar at some point, we'll talk about why that's important compared to racing. But there are four types of assets here, or four types of returns. Annual dividends from stallion shares, sales of stallion seasons, liquidity events of an asset, meaning we sell an asset, broodmare rentals, and broodmare liquidity. Okay, those are the four types of assets, or the five types of returns on assets. And once again, we're looking at 10-year funds. And the brighter the orange is my personal favorite color, which is why you see orange in so many things. But the brighter the orange is, the more intensity, or the more intense moments or years where we are expecting returns from those types of assets. Okay, so things that are pale, we think there's almost no chance that you're going to get a return in those years. Now, remember again, think about the last slide in that J curve. See how the color of intensity gets brighter as we go in across, okay? And so some of them, there's brightness kind of in the middle, it gets brighter in the middle years, and then it'll even, like this sale of stallion seasons actually goes from bright to kind of less to very pale to we're hoping for big bright orange. Okay, and so let's talk just a couple seconds about why that is for that one particular thing. The way stallion shares or breeding rights work is it's like a coupon bond. It's not a coupon bond, but from a mental thing, it's like a coupon bond, meaning you buy the asset, you buy the right to that horse, and you buy usually 2.5% if you're buying a share, just like you're buying a share of a company. You buy 2.5% of a stallion, 1/40th of the stallion. That gives you a right to use one breeding season a year, sometimes two, but usually one, depending on the contract. And you can sell that just like you would a coupon on a bond, right? You sell it and you collect the money for that being used by someone who wants to breed to that stallion. Okay. And the way, if you know anything about, now we're going to get a little biology in here. The gestation period of a thoroughbred horse is 11 months. So if you sell that season in year one, you get paid in year two, because in the thoroughbred breeding world, they're called live foal stand-in and nursing contracts, meaning the foal has to be born, stand, and nurse to the mom, the mare, and then the contract is fulfilled and you get paid as the stallion owner. Okay. So if you think about that J curve and you think about the cash flow that'll come in from sales of seasons, that first year, you have zero chance, right? Because you're not selling that season until you're not getting paid on that season until year two, right? So that's why it's bright orange. Why is it bright orange in year two and then get duller for 2 years? This is the dynamics of the thoroughbred world. That very first year for a freshman stallion is its brightest year. It's the thoroughbred racing game is all about a chip and a dream. It's about people who want to buy a horse with a brand new stallion and who's never been bred before, never been used for breeding before, and you got a chance to go to the Derby. That's what it's about. So that first year, those seasons are way more expensive. You can sell those for a lot higher because it's an unknown quantity. By years 2, 3, and 4, we're waiting for that horse to run. Because if you think about a horse, it's bred in year 1, it's born in year 2. How old is a horse when it runs a Kentucky Derby? It's 3. So now you've got 2 more years before that horse even races. It's not until you get to year 5 to know if those horses bred from that stallion are good or not. It's just how the market works. So if you get a winner, you get a stallion and you got a winner, you buy them cheap here, relatively inexpensive, and you ride it out and you hope you picked a winner. Very much like investing. For those of you, I know some of you on here, it's like investing in a startup, right? It's you're hoping that you pick that winner 4, 5, 6, 7 years from now, you get the large payouts. We're going to go through some examples. Anyway, the important thing from tonight is to understand that J curve and how the funds returns come. Okay. Now the meat of what we're going to talk about tonight. This is really the education piece. Everything that I'm going to talk about on this slide is useful for you if you never invest in thoroughbred assets and you're only investing in other alternative assets or other types of private equity funds. Everything I'm going to talk about tonight is useful from a premise because every fund in the world uses those first four specifically. The fifth one is very special to ours, and we'll get to that. DPI, distributions to paid in capital, DPI per year, which is the same thing, just divided by the number of years. RVPI, residual value to paid in capital, total value to paid in capital, and then realized depreciation. So let's dig into that first one, DPI. So it's good. I've given you biology tonight. I've given you science. I've given you handwriting. Now I'm going to give you math formulas. Okay. So the math formula tonight is what is DPI? Distributed capital divided by paid in capital. Okay. So think of once again, it's a 10-year fund. So once again, we're put into the frame of Stallions just because that's what we're talking about tonight. But once again, it could be any type of fund. You pay, the investors all put in their money. And for this simplicity, we say everybody put in $1 and there's 100 of them. So there's $100 in the fund. Obviously there will be more, but we'll just keep it simple for the math. The distributed capital is what's been returned to investors already from the activity. So if everybody put in $1, there was 100 of them, and we've gotten 50 cents on that dollar back, the DPI at that point would be 0.50. Now, and DPI in the private equity world or the venture capital world is always measured or always stated in a decimal point, 0.50. But once again, if you remember your elementary school mathematics, 0.50 equals 50%, right? So you have a DPI of 50%. Okay? So all DPI is, it's the amount of money from what you've put in as an investor to what's already been returned to you. Okay? And that's over the life of a fund. So some things to understand about Stallions and DPI. The J curve, once again, remember talking about the J curve, it's shallow, but it really affects the DPI in the first 18 to 30 months, right? Because it's shallow, because we're still investing. It's still taking that time. If you remember back to that chart, that's why I educated you on that chart, that there's not a lot of bright colors in the first half of that chart, right? The bright colors come later. There's still in years 1, 2, and 3, a chance of distributions. They still can be significant. We're going to look at some of that. But the best years on assets should be years 6 through 10. If we've done it well, we're successful. Years 6 through 10 are where we're really counting the money. Distributions in our world happen once or twice a year, either in Q1 or it should be like an and or there, June. That's just because the nature of the industry, that's when money kind of flows back in. Once again, those foals are born in the first half of a year. So you can't collect any money until those foals are born. So it takes the first half a year. And by June, we've collected a whole bunch and we usually do distributions there. In my opinion, as an investor in anything that's Wasabi Ventures Stallions, the single most important metric for me is I think about DPI. I think about how much money have I returned to investors. That's the single most important number that I think about. Some of the other numbers are going to be important as we talk about, but in my opinion, that's the most important. That's Not always the same in other types of funds. Sometimes the appreciation of the assets themselves are the most important because you get one big exit at the end. It just depends on the nature of the assets. But for Stallions, I'm as the guy who eventually always has to pull the trigger and say we're investing or not investing, and how much we're investing. I think about the DPI for my investors. How have funds 1 through 3 performed via DPI? Now, this is, I should have talked about this earlier when we were talking about the J curve. We are currently 20, once again, we do an annual fund. So every year we raise a new fund. 2025 will be fund 6. But if you remember, it takes a year, we fundraise, and we deploy that capital sort of near the end of the year. And, so there's kind of a year zero here. So our very first fund we raised in 2020. So we raised it in 2020. We started deploying it in 2020 into early 2021. And so that's year zero. So fund 1, if you think 20 and 21 are year zero, 20, 21, 22 is year 1, so on, so on. So there's been 3 years. So why I'm not talking about funds 4 and 5, it's impossible. If you remember the chart, it's very impossible to see a lot of returns. The fund's just in the bottom of the J curve. The numbers aren't interesting until you get to really year 3. And then you can start to look at metrics and see what they mean. So fund 1 has a DPI of 67.43% so far. What that, once again, if you remember back to the couple slides ago, the math, that means the investors in fund 1 have already gotten 2/3 of their money back by year 3 of the sort of returnable sort of years. It's not bad, candidly. Pretty good story. And we're going to talk about some individual assets in fund 1. Once again, fund was our first fund. Fund 2, in many ways, has a very good chance to outperform fund 1. There's some really interesting assets in there, and you can see that by the returns already. 63%, even though it's only had really 2 years of chugging along. Fund 3 has only had 1 year of chugging along, and you see it's got 21.63%. The average per year, that's just how many years has it had a chance to return, and taking the average there. So 22%, 31%, 21%. So those are pretty good returns if you think about that. If you, once again, now that you understand what DPI is, we're pretty proud of those numbers. So let's talk at the next one. RVPI, residual value to paid-in capital. So this one, another math formula for you. The residual value of the assets that are left in the fund divided by how much you put in. So the way to think of that, staying with our $100 thing, if we got 100 investors, we've got $100 in, and the assets that are still in the fund that still exist, because once again, it's a living, breathing fund. The assets, if they're worth $120 at that point, the RVPI would be 1.20 or 120%, because it's worth more than what we put in. Okay. A place where you usually see RVPI being very important, not necessarily in, and we'll talk about this on the next slide. RVPI, in my opinion, is not a very important number at Wasabi Venture Stallions. Why, TK? It seems like it would make perfect sense. How much of the asset's still worth? The problem is that this is a very private marketplace. There aren't public markets for these assets. It's not the stock market. There are not even millions of transactions happening even privately. These aren't like collectible coins or something. There is no super living, breathing market here. So the other thing is, there are private transactions happening all the time that value the assets, but for legal reasons and for strategic reasons, we do not do what's known mark to market. We'll talk about that in some slides coming up. we're not, as the type of fund that we are, because it's all private, we do not have to change the value of the assets as the fund is going on. Only if we sell an asset, then obviously then there's an exit value of that asset, and then that would change the value of the fund. So we leave an asset valued at exactly what we paid for it coming in, unless there has been a liquidity event. Okay. So if we sold it, then whatever it comes out of that. And so that might change the number. So that mark to market, we do that to another key reason is we do that to defend, to protect our investors. If you mark to market, and let's say you have an asset that you say, oh, I think it was worth 20,000 and now it's worth 50,000, that becomes a taxable event to your investors, even though it's all on paper. If you don't have to do mark to market, you really shouldn't do mark to market. So that's why RVPI for Stallions is not the most important thing. But how are we doing? So Fund One, we've actually sold some of the assets already. Some were not going to be performers. Some actually performed very well, and we made a little money, and we took a little money off the table. That was part of the returns that you saw. So that what you see in Fund 1, 2, and 3 here for RVPI is what's left of what we originally invested in, if that makes sense, right? Because once again, we're not mark to market. So for example, we had what was a Jimmy Creed breeding right that was in Fund 1. We sold that. We sold it for a slight profit, actually, from what we paid for it. But then that came out of the RVPI, right? That was an exit. Okay. So that's RVPI. The next one is total value to paid in capital. Now, another math formula for you. Distributed capital, which was the first term we learned, plus residual capital divided by paid in capital. That's TVPI, total value. Now, once again, as we just talked about on the slides, the residual value doesn't really move in our funds, right? Until there's an exit. So but the distributed capital goes together. And what TVPI really measures, this is an important metric, in my opinion, as the fund gets older. If you can start to think in years 7, 8, 9, 10, you're looking at the total value. How much assets do you still have left in the fund? And what are they valued at? And how much money have you already returned to the investors? You put those numbers together, you get your TVPI. Okay. So these numbers you should know just already for funds. I forgot mine. I was going to spend a couple seconds talking about they should substantially grow in the second back half. And it's really the best measurement at the end of the fund's life, along with IRR. The one term that I didn't talk a lot about today is IRR. IRR and TVPI are kind of like cousins. IRR takes into time the concept of time value of money. So $1 I give you today as an investor is more valuable than $1 I give you 8 years from now. IRR, which we will calculate as funds get older, because that's an important metric too. But early funds, it's just early in a fund, it's not as interesting. But at the end of a fund's life, TVPI was probably the most important number. So where are we? Once again, those are just adding those numbers together. So the funds are worth more than what was originally invested in. Because once again, we still own a whole bunch of those assets, right? And we're still early in the fund, and we've already just returned a whole bunch of the capital that people had put in. So I had an investor who was in Fund 1 ask me, I can't tell how well it's doing because I just get the money back. And I'm like, okay, well, that's why you got to understand concepts like TVPI to understand that you're getting money back and the assets still exist. They didn't go to zero, right? You didn't sell those assets. You still have them. That's why TVPI, as a fund gets older, is more interesting. Okay. This is the last term that I'm going to cover. And this one is, I will tell you, this is like if you go and get a sundae and you get that hot fudge on the sundae, and it really makes the whole sundae taste a million times better. Realized depreciation is that for investors in our fund. And this one is very uniquely a thoroughbred breeding asset metric. Thoroughbred breeding assets and thoroughbred racing in general have a beautiful part of the IRS tax code that allows for accelerated depreciation of assets. When you are an investor in one of our funds, we actually take that depreciation and we pass it on to you. That's what this is a measurement of. It's very unique in private equity. There are some other assets that might work like this. But there's the formula: accumulated depreciation divided by paid in capital. It basically is a measurement of the tax write-off that you've already gotten on your investment. Very unique to Stallions. It's one of the most beautiful assets ever that you could think of from that perspective. I'm not here to give you tax advice. You got to go get that from somebody else. But I'm here to tell you that if you put a dollar, as you're going to see here in a second, if you had put a dollar in Fund 3, you've already realized from a tax benefit 36.66% back already, meaning you get to write that off as a passive pass through, because we give you a K1 at the end of the year, and you get that depreciation passed on to you. Yet the asset still exists. It still could be appreciating. It still could be giving you returns, but the tax benefits come right away, and we pass those on a pro rata basis out to people. The last section I want to go through is I'm actually going to go through 2 of the Fund 1 assets, okay? And we're going to talk about the terms that we learned on a per asset basis here. Now, once again, a fund is made up of a bunch of assets. You know, a given fund might have anywhere between 8 to 12 assets in it in a given year. But this, I'm going to dig into 2 from Fund 1. The first one is a horse named Honest Mischief. Honest Mischief, we bought a Stallion share, meaning we bought 1/40th of the horse and the breeding rights of the horse. The first crop of foals were in 2022. Remember that J curve, remember that timeline. So the very first time foals were born, even though this was a 2020 fund, they weren't born until they had no chance of getting any returns until 2022. Think of that J curve. The first crop of runners was they just started in 2024. Just keep thinking about that J curve. Think about those blocks and the colors of those blocks, right? We're really still just starting to enter some of the darker colors. So, Honest Mischiefs, years 0 through 3. There's year 0, we paid $10,000 to buy that share of that horse. That's what we paid. Because it's a share, it's just like a living, breathing, it is a living, breathing creature. You have to pay your share of the expenses. Feed, water, most of the time advertising of some kind. You're paying your part, okay? That's that ongoing expense. Shares have that expense, okay? We're going to look at another asset that doesn't have those. That's about, for this particular stallion, it's, a couple $1,000 a year. Those are annual numbers. So that's numbers there. We had cash in of $4,000 in that year 1, once again, 2022, because those foals were born. We sold, got $4,000 in annual breeding rights. Year 3, the horses started running and they started earning what are known as breeding bonuses. I don't want to get down into the weeds of the mechanics. We can talk about it in another webinar. But in certain states, this happens to be New York, you get breeding bonuses on how well the horses who are running from a stallion, you get a piece of that. This has already been depreciated 72.41%. That's already been passed on. The $10,000 that went in, 72.41 has been depreciated and passed on. Let that soak in for you. just to show you once again, now, so we're learning about that's accumulated depreciation. We learned about the J curve and talking about that up top. Now we're talking about TVPI. Once again, we don't mark to market. In our books, it's still only worth $10,000. Literally 3 weeks ago, somebody paid $20,000 for a share of Honest Mischief. Private market, we didn't change it on our books, but you can see that the asset is becoming worth more. Why? Because his horses are running fantastically. They get to the mark, they're getting to the thing. He actually had 2 offspring win back-to-back races and earn over $1 million in 2 races out of two $500,000 purses in back-to-back races on the same day. It's kind of exciting. I was yelling at the TV. So, but once again, we don't mark to market. So the TVPI doesn't change here. The RVPI didn't change, but it's definitely coming in more value. In 2024, he was the leading freshman stallion, meaning the first year that a stallion had horses running in New York, he started earning bonus money. Once again, think about that J curve. Think about the color of those things. We have already sold 3 contracts for next year, meaning going to be bred in 2024, 2025. Right now, we will get paid for those in 2022. That's $15,000 in revenue coming to the fund. Now you see, remember, you think back about the colors, think about that J curve on this particular asset, but assets make up the fund. Now you see why the J curve takes off when you get a winner. Right now we've hit a winner. The asset could go up in value, TVPI, and the distributed money from this is going to go up. If you see, these are just estimates. That's why I put them in orange. Once again, orange is my favorite color. So those are estimates of what I'm thinking we're going to look at for revenue here in those things. Once again, this asset originally cost us 10. It's got about $2,000 in expenses a year, but you can see it's returning. It starts to really kick in years 4 and 5. Okay. That's how all these terms come together. Okay. Let's take another look at a next asset, also in Fund 1, another stallion who came in that same year, Instagram. We bought a LBR, stands for lifetime breeding right. It's different than a share. We have webinars where we talk about the difference between these, but there's no ongoing expenses because you don't own the horse. You just get a breeding right to it every year. Okay. You pay a one-time fee and then you get that coupon every year that you can sell. But you get no residuals, there's no bonuses, there's none of that. They're usually cheaper too, depending on the horse. Okay. First foals in 2022, first crop of runners in 2024. Same as what we heard about Honest Mischief. If you'll notice, it's a different J curve here. It's a different J curve. You say, oh, it's more expensive, TK. Instagram coming in was a better horse, right? They thought it had a better chance, so it was a more expensive buy-in. Cost us 16 grand to buy in. Notice that there's no expenses, so it's going to be zero forever. But we were able to, in the very first year, from year 0 to year 1, we sold enough of the breeding rights to actually get almost all of our money back. It was almost break even right there. Then, don't do that. But then you'll notice, remember, if you look about that chart, years 2 and 3, it gets pretty skinny because people are waiting to see how the horses run. We've already sold a contract. I should say 2024. We sold 2024 for a 2025 to get 20. We'll get 5,000 when this foal is born, right? We sold one of those. So we know that's coming. I don't know what's going to happen in 2026. We'll see what we sell here and how well he does. But it's a different J curve. It's a different asset. The J curve was very, very shallow here. We've already returned all the money for this asset to the investor, right? For this asset, they've already returned all of their money. Now we're just waiting to see if he hits. If he hits, fantastic. If he doesn't, he's probably going to peter out and we won't get much more out of this. But that's the kind of assets that we're investing in. That's why it's a private equity type of asset. It's high risk, We think we can mitigate uh, the risks by shallowing in that J curve out. Okay, so hopefully that gave you some really interesting terms to learn, ways to think about one, how we think about it, but really in many ways, ways you think about any sort of private asset fund that you may be a part of. I know I got some questions. Um, Lincoln asked, do we disclose the size of each fund, how much capital was deployed? Um, yes, we do. I can tell you Fund One and Fund Two were very small, relatively small, a couple $100,000 actually. Fund One, I think, was like about 300. I don't get home into the exact number. Fund One was about that. Fund Two was a little bigger. By the time we get to Fund Threes and Fours, they get closer to $1 million. We're expecting closer to 2 million this year. Happy to disclose that. And yes, you can actually go on our website and see which assets are. We disclose all of our assets. Obviously, the investors get a lot more data than just what we publish publicly, but yeah, we do disclose it. What length of life or depreciation can you use for stallions and broodmare assets? Mark, I honestly want to give answers to those questions. You can check with your accountants. It's different on each situation and how you want to play it, but it is accelerated depreciation if you choose to use it in thoroughbreds. Randy asks, so at the end of 10 years, are all the remaining assets liquidated? It depends. The answer is it depends, Randy. We would not necessarily liquidate if it's not the best interest of the investors. We would just keep the fund going and keep giving distributions. If there's like one stallion left or one asset left at that point, we might do something just because it actually is probably beneficial for everybody to, close out the fund. But it really depends on the situation. Our PPM gives us a little flexibility there to do what's best for the investors. Neil asked, for Instagram, in year one, how did you get 15,900 back? Did you have multiple? Yes. Usually in the first year, Neil, it depends on the contract for the particular asset. But I think in Instagram, we actually had 2 seasons we could sell. I believe. Don't hold me to that exact situation, but I'm fairly certain that that's the case. The contracts usually work that way. They're happy to give you in the first year because they want as many mares going to it as possible. So they're happy to let you sell as many. If you noticed Honest Mischief, we were able to sell 3 this year. We could actually sell as many seasons of him as we wanted. We have unlimited breeding rights to them because we've stuck around so long with them. So when are K1s typically distributed? As soon as we human can is the answer. Usually we try to get them out by no later than April. Like all of these things, it's gotten harder and harder to do. Do you have a minimum investment from investors? Yes. It depends on the fund, but there are minimums. Usually it's a $5,000 minimum. So, but only for a very short period of time when we open the fund. But once again, not really the focus of tonight's webinar. Any other questions about the terms or topics or any of that fun stuff? Give a couple seconds and see if they want to answer. It's interesting. I've had more and more people reach out to me recently about our funds because we're really unique. I do not know of another fund that exists for accredited investors anywhere in the world. So that's like this. So we're very unique. How about broodmares? I'm not really sure. I'm not sure what you mean by how about broodmares. We do have broodmares in some of the funds. Fund 3 has broodmares in it. Fund 1 and 2 do not. Just depends on the year if we have broodmares or not. Yeah. Yeah, we have broodmare assets in funds 3, 4, and 5. We did not in 1 and 2. Are you using the bloodstock agent? Actually, George Adams is on staff for us. He's part of the fund. How do they fit into the fund and the calculations? The same way, Neil. If I next year when I do this update of this, we'll have more. But Fund 3 is there. There were payouts. I just didn't talk about any of those because it's Fund 3, and once again they're starting. But it works the exact same way. You sell the foals. That's where your payout comes. So works about the same way. It's on the same timeline. Takes a male and a female, and they create a baby. You know, your biology lesson continues tonight. But yeah. So and and mares, you make the money when you sell the baby. So it usually takes you sell it 6 to 12 months later. So there's a little bit of a lag. Once again, all these assets have their own J curve. LBRs have a different J curve than a share, which have different than a broodmare. So blending those together sort of gives you a fund. Um, no, I don't see Mark asked about spendthrift and reducing stallion fees. No, I don't see it. I mean, honestly, the stallion fee restrictions were what they do all the time. They restricted on a bunch of broodmares that are a bunch of stallions that they can't sell. So, which is what they just don't publicize it. This year they decided to make a press release out of it. Uh, Go try to breed into mischief and let me know if they are restricting that one. Speaking of which, we uh we actually tried to get a broodmare of ours to into mischief this year and couldn't quite get in. So but we tried. So yeah. Yeah, I'll save that for a different webinar because it's probably more interesting than that. Lincoln, no, I don't think they'll implement a breeding cap. No chance. It's the whole, it's a very small controlled group. It's a private world, and it's in no one's interest to implement a breeding cap. No, no one that controls things. How's that? Let me be more accurate. It's in all kinds of people's interest to implement a breeding cap, but not to the people that actually have a say in it. Yes, and let's go locked. Locked is for those who don't know, locked is a asset in Fund 4. It's a very interesting asset for us because we actually had to buy into it while he was still racing, and then he got injured while he was racing, so he's still racing. So we still own the asset, and now we get to root for him as he's on a racetrack. So even though I told you it's nothing about racing, which it isn't, it's a very unique situation because he should have been retired, but he didn't because of an injury. So now we have a rooting interest because we actually get paid if he wins this weekend. So it actually creates income for that fund. So, and we get none of the expenses while he's doing this. So it's a very, very unique situation. We didn't talk much about this because it wasn't really the theme or the subject for tonight. The key, this is a very private thing. The getting access to the stallions we get access to is very tough, honestly, and it takes a lot of work. It's like getting any other private asset. If you do any alternative asset investing, otherwise, it's not access is the number one thing that keeps you from being successful. We have in a very short period of time have become a place where the thoroughbred breeding world actually comes to seek us out to be an investor now. I can tell you, sure the heck wasn't that way for 5 years ago, but now they come looking for us. So, and yeah, Neil, he is the favorite. Uh, yeah, I added broodmares because you need broodmares to get access, right? You can't get access to funds. You can't get access to the best stallions unless you also have a broodmare band that matches it. So you need a blend of broodmares. Also, broodmares have a different return cycle. So it's about blending a fund to get the best returns, just like you would in any other assets. So it's a combination of you need the broodmares to have access, and it's a different fund cycle. If you thought back to that chart that I showed you, the brightest years on broodmares are in the early years in the way we do it, where the brightest years for stallions are in the later years. So by doing that, you can blend the returns much earlier. That's why it's all about shrinking that J curve, right? You shrink and narrow the J curve, and you get it as going up as fast as you can possibly can. The only reason we didn't do it in earlier funds is because we needed to get to a certain size for the funds. The early funds are smaller, so you need a different type of capital base to play in the to get the broodmares that you're needed for the right assets. So to go with the stallions that you're going to breed. Once again, probably a topic that's a little deeper and not the subject for tonight, but yeah, we started adding in Fund 3 has broodmares. So another thing, I mean, since we're talking, and people seem interested in it, the in the early years we were a lot of LBRs, a lot of breeding rights, and not too many shares. Now we're 100% shares in stallions. We never do breeding rights. That's two things. One, the market has changed, and two, the type of stallions we're making bets on now tend to be only shares, right? The only people that do breeding rights are cheaper stallions. Cheaper early stallions do breeding rights, but most of the time shares are done with sort of a different class of stallion. So, and the market has changed too. You won't find too many breeding rights being offered anymore. 5 years ago they were, and they've pretty much dried up. So, just a change in the marketplace. Cool. Any other last questions? It was fun tonight. I had a fun time. I love talking about sort of learning, teaching people things that they can use and beyond just stallions. So if you like this webinar, I'm going to try to do one of these a month. Once again, I wasn't pitching to talk about when the fund will open. Fund 6 will probably open sometime in March for investing. But you'll all be on the mailing list now, since if you haven't joined Stallion Slack, you should. It's free. Anybody can join it. We put a lot of information, a lot of education out there. If you get on the mailing list on the Stallions website, you'll get an invite. So, but I hope you enjoyed it. We're going to try to do a webinar a month on a different topic. So, thank you all. Enjoy your evening, and get warm too. It's cold everywhere. It's ridiculous. See ya. Be safe.